So it's time to bring again a little perspective. I want to kind of give a investment update, a market update to what the current environment is that we're going through and why we're doing what we're doing. This is distilled from a lot of different research. It's part of the investment committee research that we go through. At the end of the day, what we're trying to do is we're trying to preserve purchasing power. We're trying to see that assets grow to keep up with this thing called inflation, because at the end of the day, over time, things cost more. And to put perspective into inflation over time, I'm going to draw your attention here to the one on the left first. So the impact of inflation over time. Again, this is the time frame of years here at the bottom of this slide. And if I move the slide up so we can just kind of see over time, if you had $100,000 that's sitting in cash, or we have a goal into the future of wanting to have purchasing power as a $100,000 example, what this shows is over time at a rate of 2% inflation versus 4% inflation. At 2% inflation, over a 25-year period of time, dramatically is cut down. And so that money may be the same amount of money into the future, but what that can buy is dramatically different at 2% versus 4%. If I jump over to the other side to kind of put this in perspective, so effectively you can think the money rots sitting in investments or sitting in cash, not keeping up with inflation. Said differently, if we want $100,000 of purchasing power 25 years from now, well, at 2% inflation, we need to have $160,000. And at 4% inflation, we need almost 2.5 times, or $250,000. And that's why in the last couple of years, when inflation went above 4%, and right now we're drifting back below 3, these things really matter, because it causes one to have their purchasing power or money grow to keep up with inflation. And what is that really? That really means it's the ability to go and buy the same bag of groceries 25 years from now, knowing that that same bag of groceries is going to cost quite a bit more. And that's why people invest. People invest to try and take dollars or currency or money that they've made and put it into something that can grow more or grow better than what inflation is. And ultimately, that's the sole objective of why you would make an investment in the first place, because if you can build that same amount of money and take those units of a currency and convert it into units of ownership of some other type of asset class that can grow better than inflation. So therefore, down the road, we can take those shares or those units of this asset that we invested in and sell some of those, converting it back to the units of currency or back into dollars, is how historically you've been able to keep up with inflation. And so that's why we're doing this. And so what drives our reason of wanting to own companies, what drives our reason to want to make investments in the markets, which is really investments in hundreds of some of the best run, most capitalized companies that do business around the world, is because we're wanting to participate in the growth of the revenues of these companies. All these companies that are out there at the end of the day provide a product or a service. And when they're done doing that business of selling that product or providing that service, they want to leave revenues or profits to the shareholders of those companies. And we get to participate in that as investors. And what this is showing is over time, the earnings of the market, or which is referred to, the market is a funny word they use to represent 500 of some of the largest capitalized companies that are traded in America, do business around the world, referred to as the Standard & Poor's 500 or the S&P 500. And this is showing over time, again, how the growth of revenues from going back into the financial crisis over time have continued to just keep moving up. They don't move up in a straight line. They have setbacks like COVID. But what this is showing is over time, they continue to trend up and to the right. And the bottom shows kind of quarter by quarter how that happens. And again, it's little changes over time that go up more than they go down, that produce the revenues that increase the value of these companies and therefore increase the value of those companies or the prices of those companies. History is the reason we make investments in these things, because historically speaking, it's one of the few things that are out there that do a really good job of beating inflation. And yet most people don't participate in it because they don't trust it. And they don't trust it for a couple reasons. They don't trust it because you could go back and say, well, yes, in the Great Depression, there was no growth for years. Or you could go back and talk about it in the 70s, where you had, again, a sideways move in different wars. But historically, over time, the market has grown, especially for all of us that are still alive. Post World War II, have basically done a really good job of growing, and we expect that trend to continue over long periods of time, which is why we invest in these companies. But what happens is that there's setbacks, there's uncertainty from time to time, and it causes panic, and it prevents them from making those investments. And one of the things is this always ongoing worry or fear about this R word called recessions. And what I like about this slide is to bring perspective to recessions. And outside of the Great Depression, which, again, if I focused on the Great Depression lasted several years. And yet it's an anomaly relative to all the other recessions, that for the most part, most recessions last a few quarters, maybe a year. A rule of thumb is 2 negative quarters of earnings growth, of revenue growth in the S&P 500 could classify a recession. The actual technical recession is defined slightly differently, but we'll just use that for a rule of thumb for the time being. By and large, what this simply means is that throughout history, there have been periods of time, about a year in the making, where markets could adjust, revenues could come down. And this is, again, from a financial planning standpoint, why it's very important to have cash reserves or emergency funds, because when these recessions show up, the whole goal is to not panic or not have to sell when these markets correct. And what people are afraid of in the markets is the downside. And so I'm going to, again, kind of blow up what we're looking at here to see it better. This is reflecting the bear markets of the S&P 500 index. And so the Great Depression was a disaster. There was no technology in place, and some of the rules that are in place now to prevent this weren't there, which is why they were created. World War II, again, was a bit of a disaster. But post World War II, what they kind of call more of the modern era, what I want you to see is downturns and how long they were. So 37 months is a longer period of time. But then as you get into the 80s and 90s, 14 months, 6 months, 8 months, 18 months, 21 months, 4 months, 3 months, 30 months. That's the tech bubble bursting. 17 months was the financial crisis. And then as we get into even more modern times, a 20% correction in a month before COVID. You had in 1 month 34% correction during COVID. And in 2022, we had a 25% correction in 9 months. And when this slide gets updated here in 2025, we had about a 20% correction in about a month and a half. The shorter periods of time is the bottom line. But these downturns are severe. They cause people to panic, and they cause people to get out of their investments. It's why the market goes down. More people are selling than buying. And what people miss in focusing on trying to avoid these is they miss what the upside looks like. And so this is just the same slide now showing what the upturns or up was, the movements up before the next down. And what just stands out to me is the market goes up more and lasts longer than the market goes down, and how long the market stays down. So coming out of the Great Depression, coming out of World War II, you had your 70s and 80s. And again, as we get into, this is some of the big run-ups in the 90s and 2000s. You have, again, substantial upsides that last a lot longer. And if I put these two together, it looks like this. And this is what you have to tolerate if you're an investor. You have to tolerate some short time frame severe downswings to benefit from the long-term upswings. And to put perspective to this, it looks like this over time, up and to the right, with setbacks occasionally. That was showing the overall trend of bull and bear markets going down for long periods of time in form of months, and market going up for longer periods of time. If I now show a different way of looking at that, let's look at it from a calendar basis, an annual basis. And again, This is one of my favorite slides. What this is showing is in any 12-month calendar year, how much did the market decline from any point down before it recovered? And the downswings, again, if I go back here to focus on the financial crisis, you had the markets drop 49% in the second half of 2008, and then again in the first few months of 2009. Severe, unprecedented. The tech bubble bursting was pretty bad. If I slide over here, and again, this was the 1 month downturn in COVID. But what I want you to see is in any calendar year, there is oscillation from, may I say, the all-time high to a correction and then a recovery with different percentages. If you actually just looked at this as what did the market do at the end of the calendar year, it looks like this, where you have only a few years over many that the market actually finished the year down. Market was down 49% in this, again, second half of 2008, and then down the first few months of 2009. Notice that the market dropped in the year of 2009 almost 30% in the first few months of the year. So notice in 2009, it didn't have a downturn for the year. In fact, like the year with COVID, it ended up because as an advisor, what clients miss in getting caught up in the short term, sometimes severe downturns, is they miss the recoveries and they miss the upside, which is often greater than and lasts longer than. And so in my example for the financial crisis of 2009, after dropping almost 30% in the first few months, it ended the year up 23%. Or the year of COVID, where it dropped 34% in a month, the beginning of 2020, it ended the year up 29%. And so though the market has downturns in any calendar year that you could say, hey, my portfolio dropped in 5, 10, 15, 20%, it often didn't stay there. And what people fail to realize is that the returns that you need to make over time to beat inflation, you can't react in the short term, because what happens in volatile markets that cause people to panic and get out of investments also cause markets to recover quickly. And some of the best days in the market come right after some of the worst days in the market. And if you miss just a few of those days, you can cut your return substantially over time. So over the last 20 years, if you stayed invested with $100,000 in this S&P 500, it grew substantially. But if you only missed 10 days, not 10 months, not 10 years, 10 days, you cut your return in half and then some. And if you miss 20 days, it's pathetic how damaging it is to get out if you miss that recovery. And again, that's why we focus on cash reserves, so we don't have to react to those types of things, because what people need to beat inflation and what we seek to help provide is average returns over time in volatile markets that go more up than they go down, but they do go down. And so this is showing in your different asset classes of, maybe I would say, large cap companies versus small cap companies versus companies around the world versus cash. In any 1 year period of time over the last 20 years, the year could have given you a downswing of a negative 43% or an upswing of 56%. And this isn't calendar years, these are rolling years, but this is kind of showing you how much one could make in a 12-month period of time or lose in any one of these asset classes. But what I want to show you is if you average all that volatility out over time, your average returns for the last 20 years handily beat inflation and the return sitting in cash. And what I want to say cash, because there's a pretty decent interest rate now for the last couple of years in cash. It's coming down as the Fed cuts rates possibly. But people feel comfortable in cash. And so and that comfort comes at a risk, because what history has to show is, going back for a pretty decent period of time, your likelihood of beating a market return, beating an investment return by sitting in cash feeling safe is at great risk, because the longer you sit in cash, the greater likelihood you will underperform and underperform by quite a magnitude. And so that becomes lost opportunity for money that needs to be beating that inflation. Again, if I focus in on this, what this is showing is, there's an 80% chance of the market beating or cash underperforming in any one year. And as you get out farther, especially when you get into thinking retirement, if you sit in too much cash for decades, you're dramatically missing out on opportunity. And that opportunity ends up looking like this about how much return potential you miss, because again, the markets go up a lot more over time, or at least historically they have. It doesn't guarantee that for the future, but from history being the only guide, sitting too much in cash for too long a period of time can have a dramatic effect on your ability to grow wealth and beat inflation, which is the sole goal for most people. One of the other things I want to bring into perspective with regards to the markets and what one could be concerned about is, let's take a look at the personal finances of, may I say, the American population and how they're doing. And I'm going to put that focus in the personal finance side first on just kind of retail sales. So this is what we're spending money on outside of food, because obviously food is probably more of an essential. And what you're seeing is over time, with some hiccups in the financial crisis and some downturn a little bit in COVID, where people couldn't spend the money, growth happens to be about 2 to 3, maybe 4% over time of us growing how much we're spending on stuff. And again, if we're spending money on stuff and we're spending more money on stuff going forward, those are more companies that then get to benefit from the increased sales, which increases the revenue. And so how retail sales and how we spend money over time directly affects returns of the companies of the stuff we're buying. But what's amazing to me is that it's pretty consistent over time. And there are setbacks where we panic. There are setbacks where the interest rates or the environment changes, but the trend is your friend, in that most of the time, millions of people in America and billions of people around the world are going to wake up and they're going to hopefully brush their teeth. They're hopefully going to have some breakfast. They're hopefully about gotten dressed somewhere in there, maybe showered. So you're, before you even get out of your house, you're buying toothpaste, you're buying a toothbrush, you're buying soap, you're paying your utility bills for the electricity of the lights you turned on, you're paying electricity bills for the water that you get, you're spending money on the food, you're spending money on the coffee maker and the coffee. And if any one of these things breaks or you run out, you tend to go buy more. Those are retail sales. Those are all companies daily producing products and services that we're consuming and continuing to consume, and often in greater quantities. If I shift down and then looked at personal consumption, that's just another way of saying the same thing with retail sales. Huge effect there in COVID, but for the most part, it just follows this trend line of about 2% a year over time that we basically consume when it's adjusted for inflation. If I show another one from a personal savings rate, again, when you get into trouble in the markets is when people can't save money. But throughout history, this has never gone negative. In COVID, again, we all saved a bunch of money because we couldn't spend any of it. And that's part of what drove some of the inflation when that money finally came to work. But over time, what I want you to see is that basically there's been an average of about a 6% savings rate. And if the savings rate goes down, it actually means we're usually consuming more in retail sales, not less. The last one, I think the one that's most important that I want to reflect on, is just debt service for household debt based on your disposable income. So this is taking all of Americans and basically saying, hey, how much of your income is being allocated to debt service or debt payments? What I want to draw your attention to is the fact that this dropped over time, and we're at some historically low debt to service ratios. And the higher the amount of income we spend on our debts, the greater risk we have to retail sales, to the economy just in general. Because basically, if you're spending money on debt, you've spent the money you borrowed, and now you're paying for what you bought. And when the debt service ratios are high, the average American or the average consumer in the country sometimes can't afford it, or sometimes there's setbacks, and that's where you can have some recessions. That's where you have some risks until that debt works itself out. Again, with these levels staying low, not that there can't be a recession, not that there can't be an economic hit, But Americans are in pretty good space to tolerate uncertainty because their debt to service ratios are low. And that's basically because a lot of people got hurt in the financial crisis. They had too much debt. People knew people who had to foreclose on their home or had a negative effect of having too many debt payments. And so Americans are really good at learning their lessons when they get burned, and they haven't let themselves leverage back up. And that's been a good thing for the stability of the markets and investments and retail sales and the like. And at the same time that, ironically, the debt ratios have come down, the amount or the value of one of the biggest components of debt, which is households, the value of real estate, the value of households has continued to trend upward. It probably is going to go sideways here for a while because the upswing in COVID is still being digested. Because a lot of people, there was a lot of demand for new homes and for existing homes when people decided they didn't want to live in the concentrations of some of the cities. And there's been a lot of kind of moving around of the population in the United States, and that required new homes or required home sales, and the demand bid up the prices a little. But the point being is that the servicing the debt is down, and the value of the assets that most people have with debt are up, which is a good thing. So what do you do with this? How do you invest? One of the concerns that I have for a lot of clients is that they want to avoid the reward that comes historically from owning companies or owning investments in the market. And if I said differently, if I blew this up a little bit, they want to be conservative, and they want to have more money out of the investments in the market, which is the orange, and have more money in cash and what would be called bonds, versus the different opportunities that are out there to be all the way to the other side, which is aggressive, which is having the majority of your money in equities in the markets and less in bonds and fixed income. And what I want to point out is it's a fool's errand, I think, to be more conservative from a growing wealth standpoint. And what I mean by that is that if I show how returns work over time and we go back and look at the downturn, so if I come back in here and look at the financial crisis, well, what it looks like is, okay, the market return of an aggressive portfolio dropped 28% versus 23 versus 19 versus 15 versus 10. So that was a pretty big difference, 10% down versus 28% down. But that was really the last year that diversification really worked on the downside, and there's a lot of reasons for that. But if we moved forward again with the most conservative being on top, and then we come out to 2015 was a flat year. So this is 2015 is the 1%, 1%, 1%, 1%. Or if we did the 2018 year, 3% down, 3% down, 3% down, 2% down, 2% down. Again, not that much of a benefit for having a heavier weighted allocation to the conservative model. If we got into the years of COVID, again, the markets dropped substantially and then recovered. The returns were very similar, 11, 12, 13, 14, 15. But again, in 2022, when the markets corrected, down 16, down 16, down 15, down 15, down 14. And so in the down years, other than the 1 year of the financial crisis, the conservative portfolio didn't protect us that much. And what does it really do if you're too conservative? Well, it limits substantially the upside, because if we look the year later, markets recovered up 21, up 19, up 17, up 14, up only 12. Or if you get further out to right, this downturn that we had in 2018, well, more allocation to equities gave you a 26% recovery, 24, 22, 19. The conservative was only 17. Again, if I came out over 23, up 22, up 22, up 22, up only 14, what it shows is the conservative return over time averaged 6.2%. $100,000 grew to $300,000. Great. Over a 20-year period of time, you tripled your money being conservative. But what I would show you is that on the flip side, an equity portfolio heavily weighted in equities, the same $100,000 over the same period of time grew to $500,000. And so the downside protection, which is becoming less and less over the last several years, really the downside protection was really only in the 1 year of the financial crisis. that downside protection, or that to experience less of the downside, by definition, removes a lot of the experience of the upside. And what we would rather see clients do is allow their advisors, and what we try and do for our clients is to help make sure you have your emergency fund you need, help make sure you have your cash reserve fund set aside. So we have 12 to 24 months of cash that you need, or investments converted back to cash to spend on the things that you need. So if a recession happens, if one of those downturns happen, we have reserves so we don't have to sell when the markets are down, so that we then can allocate the portfolio more to where the returns show up over time, which is more on the equity side of things. And so if I just summarize this perspective, it's this: the more you focus on a day to day, the more you focus on short term fluctuations and allow yourselves to emotionally engage in those, the more you are most likely going to prevent yourself from benefiting from greater returns that come over time from us as Americans consuming things, buying products, enjoying services, and having companies that generate profits over time, that drive markets over time, and participating in those markets, participating in ownership of those companies is historically one of the best ways to beat inflation. It's one of the best ways to build wealth if we can not allow ourselves to restrict our portfolios for the rest of our lives because of how we feel or because of the concerns we have. Because to satisfy or medicate yourself with being conservative, you also dramatically limit your ability to build wealth and benefit from the fruits that come from time and returns in the market.